Hello, friends. Welcome to Nirmal Bang. I'm Piyush Jain, and today we are going to be talking about the fund universe, about the investments, the market climate, how broadly the macro environment is looking like, where actually the fund flows are going by. And to understand all of that, today we have an industry veteran with us. Let me introduce the guest, Mr. Swarup Mohanty, the CEO of Mirae Asset Investment Managers India. Sir, welcome to the show.
No, thank you so much for having me. Really a pleasure always talking to you, Ish.
Sir, the last time I remember, we talked about all the positivity around the Indian investment climate. Since then until now, we have seen a couple of movements in the global markets. We have seen more interest rate hikes. We have heard about all the inflation controlling efforts by the central banks in the global markets. Due to that, we have seen some slowdowns as the global PMI numbers are indicating. Europe is seeing more slowdown, a bit of slowdown in China, a bit of slowdown in US. So broadly, slowdown, inflation slightly remains higher, but we continue to see global flows again enjoying the benefit of liquidity. So how are you assessing? How are you assessing on a top view basis the global investment climate?
So I think let's divide it into two parts of how the globe is and how the globe looks at India. Okay. The first part, obviously, you cannot take away the fact that global data continues to remain delicate. And when you look at the impact of, say, the COVID and post that the war, it takes time. And we were talking about inflation. Inflation is not something which happens in a hurry. At the same time, it does not get controlled in a hurry. With that comes the interest rate rise, and so it takes time for all that to get mitigated. And with the underlying then becomes weak, the broad economy of the world does get impacted, and there is no shortcut u-turn to this is a fact which all of us know. Hence, when you look at investing, you have to always keep the global data delicacy in mind, and it'll be difficult for us to sort of conclude on that. That's the reality. Now, when you look at the second part of the fact that the data points of India continue to stand out, and earlier when you look at India points, and we've discussed this enough in the last 4 or 5 years, India used to be a very kind of a sector or a service oriented country to the world. But slowly but surely, it is becoming more and more diversified as a story. And then the India data points, and if you look at the data points post COVID, and pick up any point, whether you're looking about exports, imports, energy, power being part of energy, medical insurance sales, four-wheeler sales, any data point, GST collection. I'm sure the income tax collection this year will also be higher than the previous year. The number of people filing
Already
for income.
robust. Yes,
Yes.
absolutely. Already robust. The numbers so far are already
Yeah.
more than 25% of the annual
True.
estimate.
True. And add to that the manufacturing story looking good, the bank NPS getting cleaned up. It is not just one small story emerging. And look at between this year and next year. In my career, I think it's the first time I will see India growth now impacting global growth. Because in the globe, US will slow down, China will slow down, Japan will also slow down. Probably Germany will look okay, Europe might show marginal comeback. It's that India growth which will put the global growth in a positive sort of trajectory. When you see that in perspective, there is no doubt or debate that there is fair amount of interest of the globe in India, and that is playing out in the way money has come back to India. Now, when money starts coming back to India or any other country, I have a very simple theory on it. When you look at any adverse situation in an economic form or any other adverse situation, there is always a flight to safety in money. And then the flight to safety is always to own the dollar, because that's the strongest currency of the world. And that had happened post COVID and the war. When there is reversal of money out of dollars, it would mean that some part of these delicate data is getting factored in the minds of those investors. It's not that they rush to India, because if you look at that point of time, in a last discussion, I clearly remember saying that, in the short run, India looks a little expensive. But in the long run, the story of India going to 3 trillion to 6 trillion
Yes.
cannot be denied. Right. So when it moved out, it probably bought US tech first because available at very good prices. It bought the Hang Seng, then went to Korea, bought some Korea, and then came to India. But the simple point meaning money moving out of dollar is a sign that a lot of this delicate data and the fact that some amount of reversal of rates possibility though in the long run but is beginning to come into people's minds. At the same time, one is not leaving the factor that current data of inflation and interest rates remain a little delicate. So it's a good thing that money has started moving out of the dollar, and I hope and pray that it continues because for a change, the Indian data stands really like an ocean in this whole world. I've never seen this happening in my life.
Yes, and as a CEO or the fund managers in your fund house, when we actually take a look at the data, tax collection we just talked about how robust the number is, credit growth remains resilient, GST collections showing no signs of slowdown, and when we take a look at that, what sort of undercurrent it is telling us that both equities and debt perhaps remain as a solid momentum. I'm trying to now ask from a viewer's perspective that they might be thinking sometime back that okay, the market is looking expensive, the markets are not doing anything, and we saw Nifty Sensex again breaking out, touching new levels, and levels are just sort of print on numbers. But what it is telling us, is it liquidity? Or is it that underlying momentum is telling us the EPS will keep on moving up?
So I'm happy you asked that. I need to answer it from the investor's perspective. And let me look at it from the investor's perspective. I asked the investor one simple question. What are you going to look at? 65,000 odd Sensex, or will you look at 6.5 trillion Indian economy? Because when you look at the last 19, 20 years of Indian stock market, 1 lakh would have become 19, 20 lakhs. And would you have been required to do? Sit at home, right? Active fund managers would have given you returns higher than that. But what invariably happens is we don't see the big picture. That this is the only country which is now giving it this chance of doubling its economy in the next 8 to 10 years. If you internalize that, you would know that you would participate in the market. It's very interesting to see that the same investor is behaving very differently when it comes to lump sum investing versus SIP investing. The SIP investor is actually participating. The lump sum investor, and if you look at industry data, is redeeming as if this is the last day of the economy, especially on the large cap side or the flexi cap side.
Mm,
And there is a huge return chasing happening in mid and small cap. Are
absolutely.
they participating? No, they are timing. And I tell everybody just one thing: it's your money. You decide whether you want to stay or not. But when you go out, just write down the exit NAV in your book when you go out. And next time when you decide to come back, check what NAV are you going at. If you are coming in at lower NAV, fantastic. But I've done that test with myself in the past when I was a market timer at some point of time in my youth, and I failed miserably at that. So when it is very clear that this economy is going from 3 to 6 trillion, and one of the best ways of getting this growth into your side of the portfolio is through the capital markets, then you have to sit in the capital markets to enjoy that. That's what I leave back with investors. Now, when there is volatility, there is opportunity, and that's true for the debt side. If this inflation data were not there, if this slowdown were not there, then the interest rates that you're getting at this moment or the yields that you're getting at this moment would also not be there. When all these factors in, the yields will also be very different. So the opportunity for debt investors as of now is still there. I mean, between now and when the inflation subsides is the journey of getting good yields from your side, whether it's the bank deposit or a good mutual fund. I, as a mutual fund guy, will always argue that the mutual fund portfolio on diversification, on YTM, on the possibility of catching the interest rate movement is in favor over bank deposits. But that I leave on to the investor, how they view the risk profile. That's their call. But this is a
But
great time probably to lock
I
into
want
the
to
yields.
I want to jump in
Yeah,
between.
yeah,
I'll come back on the equity question, but since we are
yeah.
talking about debt here, there is a one typical observation in the data which we have seen this month. and that is there is a very sharp, very decided sort of movement happening in shorter duration, ultra duration, a bit of arbitrage, which normally again is seasonal, but it's a very decided factor by the market participants that let's buy the shorter duration funds right now. What's the reason for that?
I mean, the yield between the short and long is not very much. No, it's almost a straight line yield curve. So people then typically don't commit long to debt. I've always had this opinion that people time debt more than the time equity, and that is what happens. Rarely does an investor match his or her investment horizon to that of the fund. I mean, if you have a 10-year debt money, why are you then buying short? Is a question which I've always asked, but I have not found any answer. The good part is the equity part has started doing that, but I'll wait for the day when the debt guy starts doing that. If you just do category wise, the long fund would have given the long fund return, irrespective of the
Uh,
volatility. But as
sure.
investors, we come from a very strong fixed return regime, so we are ready to believe 7% FD yield, yet to believe in YTM. So that's the catch, and I think some more education needs to be done. And I don't know whether it will happen or not, but the basic principles of investment are the same whether it's equity or debt. You have to match your investment horizon with that of the fund horizon. That does not happen, and hence the short-term timing always happens. Is my opinion. I can be wrong also.
And now coming back to the equities, and you already actually picked up what I wanted to ask you. Um, is it mere chasing the small caps and mid caps which is happening, or when you take a top view, there was a valuation sort of catch up which was happening. Like why now small caps and mid caps are getting slightly higher attention?
Yeah. So the valuation was there a year or two ago. Right now, the money is see. You and I have tracked this together for a long time. Okay, on the equity side, people buy last 1 year performance. Right, there is this great
Absolutely,
belief in investors that return
it's going to
on.
continue.
I'll say that where on the large cap or the flexi cap side, there is this huge confusion between alpha and return. Lot of people actually, and correct me for saying this, actually confuse alpha to be return. Right, and that's why probably they are abandoning that part to start chasing mid and small. It's perfectly fine as long as people are aware of the risk they are then increasing in their portfolio. If they are okay with that, no issues at all. But if they're just going in for return chasing, more often than not, the experience will not be what they desire. Is what is a fact, because finally the good investment experience is about marrying your risk profile to your portfolio's risk profile. We start off as return chasers, but ultimately a good investor is one who mitigates his or her own risk. If that risk part is taken care of, not an issue. But I doubt if that's happening. What's happening is a large cap investor is selling large cap to buy mid and small. I don't know how much that is right from a risk perspective. As long as that part is taken care of, rest is okay. But we mutual fund guys absolve ourselves saying that past returns, we are not responsible for past returns. The investor needs to take cognizance of that statement. So, you know, near term or past returns can be that much weightage in your portfolio, not to the tune that we are seeing at this moment, is a very honest submission.
Sure. And now, sir, I want to ask you, sir, one observation I had when I was having a conversation with market veterans between January and March. At that time, the globally inflation was high, interest rates were going up. All the central banks, including Indian Bank, they were cautious because they wanted to control the inflation. So there was a feeling, a perception that because of this rising interest rate regime, bank earnings actually perhaps have seen their best. And from June quarter, we are going to start seeing some moderation in terms of growth. It's not that things are going to turn bad, but moderation in the growth. We have seen the June quarter numbers, and largely the banking sector is painting a tremendous robust picture. What's your own sense about the banking sector right now, both private and public sector banks? How's the sort of how's it looking to you?
Actually, if you look at the banking story, it's a revelation between pre-COVID and post-COVID. When you go and remember the pre-COVID stories, there were NPAs, there were no credit offtake, and the balance sheets were not looking good at all. Yes, the interest rates would have helped in the income of the banks, no doubt about that. But what has happened is there is systematic cleanup of the NPAs in the banking system. At the same time, parallelly, not to the tune which banks would have wanted, but definitely credit offtake has started rising. The comeback of housing has again given a great boost to bankers on the home loan side, which pre-COVID had practically died down, right?
Yes.
Today, when the global banking is in complete disarray, our banking is completely looking just the opposite, right?
Yes.
Some amount of what you say is absolutely correct, that once the interest rates sort of mitigate, can impact in a possible slowdown on banking. But to be fair, I think the banking balance sheets have become fairly robust and strong in the last 2 3 years, and that will help them. And cycles in profitability come and go, but what is more important is whether the core balance sheet is strong or not. Today, we can say that core balance sheet is far superior to what it was just 3 or 4 years ago, and that will help banking definitely in the next 4 5 years. Please understand, out in the Nifty 50, 37% is financial. So it's a very important part of our stock market, and it's very
That's why I asked
important.
this
uh,
question.
this part of the industry is in good shape, and I dare say it is in a far superior shape than it was in the past. And then these data points of credit offtake and all can only get bigger. Yes, the base is low, I agree, but it can only get bigger. So we remain constructive on the banking side, though our banking call is probably 1.5 2 years old. But our call has been more on the private banking side than on the public bank side. That's been our call. Right or wrong, I'm not commenting at all. But that's our view, that we remain stronger on the private bank side than probably on the PSU bank side.
And that on the large cap private banks, or any specific in the
No, no,
private bank,
we
like
find
because
merit
smaller private
across
banks.
sizes.
Sorry,
We
sir, please
find
continue.
merit. See, it's a very specific. When you talk about bank stocks, they're very specifics, but we find value across the chain. There are good
And
stories there.
right. And what's the thought around the recent co-lending sort of agreements, approvals coming up? Is that something which is going to change things for NBFCs? Is that something which is going to help NBFC garner sort of more great growth rates? Like, how's the NBFC sector looking to you?
Actually, if give my personal opinion, the NBFCs, due to whatever reasons, have not got their due in the last 4 5 years. I mean,
True.
the strength that they bring to the Indian economy in the unorganized side, and the kind of work they do on that side in helping small businesses build up, small borrowers also build up, goes unnoticed. And probably in the past, due to one or two bad instances, the whole space had got a very negative sort of look. But again, that part is also got structured, and we will see them playing in tandem. There will be a banking market, there will be a non-banking market, and both have to exist and grow consistently for the Indian economy to structurally grow from here on. You need money for business, and hence, this becomes the fundamental. But what has happened probably in the last 3 4 years, like banking, I think the NBFCs are also shaped up well. Regulator also been good. Let's face some facts, that we are very lucky to have the central bank the way it is. It's probably, as a central bank, the RBI stood out globally. So the framework, or the regulatory framework, is also very strong. So when you put everything in totality, yes, both sides will gain, and we remain constructive on both sides.
Okay. And between the banks and NBFCs, is there any particular favor, or like
No, they,
uh,
is there
because as a fund you have a lot of money, so perhaps both would be like in terms of their own merits.
Yeah, merits on particular company or stocks in particular. I mean, we look at the space constructively, but within that, there are some stocks we would value more, definitely. It is that cliched statement of you know completely bottom up stock picking is in play, because when you look at the broad market, the erstwhile value is now growth, and the erstwhile growth is now value. So a good stock picker is finding enough value in the market in erstwhile growth stocks. So
Fair enough.
uh, uh, it is very stock specific.
I want to ask you, sir, on technology. A very specific question. Again, this is a sector which did not do much last year. It was being expected that perhaps towards the end of this calendar year, we'll start seeing a global recovery in technology stocks. So yes, in US, some valuation chasing happened. But how's the Indian technology sector looking to you, and what's the stance of the fund house on that?
So two answers, one from our side and one possibly from the investor side. Yes, we do see that some more pain remains in that sector. So we could see some volatility there. That is the house view. But from the investor's perspective, I leave you with that question: when will you buy this sector? When everything is okay, or when it's a great sector and things are not okay? So choice is yours. Uh, Please understand that when things are okay, the valuation will not be okay.
So our viewers, I think if you're listening to Mr. Mohanty, I think for us the writing is on the wall, and I think as per me, I think every investor
See,
should
it's
always
like banking. IT is also a core sector, and you cannot
yes.
deny that the country has to grow. And for some unforeseen circumstance, these great companies are available at some prices, right? And then, if you want to create good substantial wealth, one has to wait for these circumstances. And if you have good companies available at great prices, then you have to take a call, and your call can be in contrary to the fund manager. Let me tell you, there's nothing wrong with that.
Absolutely. Now, sir, comes my favorite part. I want to ask, we 6 months have passed by, another 6 months for the calendar year, 9 months for the financial year. In this particular part, sir, as a fund house, which are the top three sectors right now?
See, I think for us, the sectors remain the same as we speak. For us, what we see as a broad market, I think we take a lot of, what can I say, comfort in the final change in manufacturing in India. That's something which we are talking about very, very actively now. What's happened in Indian manufacturing due to PLI is something which should be noticed, because it's not just about one small pocket. We are seeing green shoots across, from IT's hardware product to, say, semiconductor. A lot of talk on semiconductors now, but white goods,
Defense
cars,
also?
mobile phones, we are seeing across board green shoots happening. Now, broadly, if you see, the corporate tax is now in line with the world, maybe a little cheaper. Indian manpower is probably available at its cheapest. We are cheaper than Philippines and Vietnam now. So the point I'm making is the ground, for manufacturing from here on is been set. So if there is one sector, or one area which one should start owning from a long term perspective, these are early days for India manufacturing. It's good time to probably start buying into manufacturing, is a fact. For us, retail bank remains a focus. Healthcare, we talked about it at the beginning of the year, is beginning to play out, and but it's still a long way to go. What used to be healthcare last year is probably IT now. So again, I repeat that question on IT to the investors. We might not be as bullish on IT, but someday it will become good. But that's happening to pharma now, or healthcare now. Consumer durable and discretionary continue this space, and as India grows from a low mid-level consumer to mid and high-level consumer, the story of consumption gets a revival. As we speak, auto, we've always played auto ancillary. We are contrary in the market with our holding on the new age businesses. We feel a lot of value has been found there, and thanks to our inflows, we've been able to buy them at good valuation. So we are sitting strong on that. Last time also we had discussed that telecom now looks a very clean industry, and an FMCG is what we'll say. So broadly, 4 or 5 sectors. Little low on IT and metals, because metals, obviously a lot of run up has happened, and we feel some more pain to go on ITs, as is broadly our sector.
Just one follow-up question, sir, as we move towards the end of our conversation. Discretionary space, consumer discretionary, a sector loved by most of the investable universe. Wanted to ask you one thing. In terms of discretionary, it's a very broad universe. Like
True.
what in particular you like in it?
No, see, again, what happened during COVID is very, very interesting. It's the first time as individuals we could differentiate clearly between what is consumer staple and what is consumer discretionary. Earlier, it was still a blur. So within discretionary, we've always been a more discretionary player than staple player. That brought we run a consumption fund for 15 years now, and then if you look at the consumption fund performance on a risk reward or standard deviation, it would be far superior to a lot of flexi caps that you own. From that perspective, the broad consumption had always looked good. Again, stating the fact that it's very clear bottoms up stock, but at this moment we look at discretionary over staples a bit.
Okay. And new age businesses, what do you prefer in that? I'm not asking
So
about
the four
stock, but
stocks
I'm
that we
saying
prefer. Now
new
the
age
four
businesses
stocks
also
that we
there are
prefer.
platforms that there are different categories.
No, see, initially it was very fintech sort of oriented or anything that was tech oriented, but the four companies that we favor are there in our portfolio, so one can check them out, and we remain confident of the four, and we're holding them on from the day we bought. I mean, we've taken some flack on them from the market because we are a little contrary in the market, but when you take a contrary call, some of it is natural to come our way, but time will tell that whether we are right or wrong. But we back our four organizations as we speak. They are there in the portfolio. One can check them.
Okay, sir. I think as always, it was lovely to get insights from you about the market, sectors, what as a fund house you're thinking, and always, we have always been grateful to get all those insights from you.
No, no, I have to thank you for getting me back. Always really a pleasure talking to you as usual. But these are times when investors need to have conviction, and you will only make money if you stay in the market. And that's something which we have to impress upon anybody, because for a change, the India story is broad based and the India story is fairly strong at a fundamental level. I've said this
Absolutely.
from in 2016, redeem India at your own risk, and I still stand by the statement in 2023. I'll probably stand by that statement in 2033 also.
Yes, and we are in a market which actually is facing once in a century increase in the middle class, and that increase in middle class is bound to actually have a very large impact on the stock market. So perhaps all our viewers who have been listening to Mr. Mohanty, remember that expansion in the middle class is always proportional to expansion in wealth, and stock market always follows that. So with that positive thought, we actually move towards the end of this conversation. Thanks a lot, sir. And for our viewers, it's a wrap on the show. Thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.